the Fed can't buy it all, because if the Fed bought it all, the dollar would collapse. Because you see, when the Fed speaks in terms of they're going to do whatever it takes, understand that doing whatever it takes means debasing the currency. Because implied and implicit in that statement is that they basically will print any amount of money, which they have, and they've actually printed a lot more than they admit. And the amount of money in existence is not reflective of the Fed's balance sheet, except the Fed's balance sheet is getting scary big. But that's only a part of the story.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs. Welcome back to Liberty and Finance. We're always glad to have this returning guest. Rob Kirby is a proprietary analyst. He's the founder of KirbyAnalytics.com, and he joins us this Friday, August 6, 2021. Rob, thanks for coming back on.
Pleasure to be with you again, Dunnigan.
If I ever let it go more than a few weeks without having you on, we start to get these comments of increasing frequency from our viewers saying, when are you going to get Rob Kirby back on? So I know we tried, and you were out of pocket for a little while. We're both back now available to do this, so we're seizing the moment. And one of the things that got me to reach out to you this time was an article that came out on a Wall Street on Parade, which says the Fed announces plans to permanently backstop Wall Street with a standing repo loan facility of $500 billion starting tomorrow. This was back on July 28th, so it's about a week ago. And my wife and I have been talking about this a lot, but just would like you to weigh in on it and give us your perspective on the Fed continuing to have to take additional extraordinary measures. A couple aspects of that we want to talk about, but please first give us your take on the meaning and the impact of this announcement, and then I'll have some follow-up questions for you.
Okay. Well, first, a good place to start is to explain what happens when the Fed engages in repo activity. When the Fed engages in repo activity, they effectively borrow or they take securities off the books of the dealers, the people who are responsible for putting bids in at auctions. Basically, it's the investment banks, the big banks, JP Morgans, the Citis, the B of A's, the Goldman Sachs's, Morgan Stanley's. So effectively what happens is the securities are being held by these dealers, and they don't really want this stuff. The Fed doesn't really want it either, because they're very concerned about the size of their balance sheet, which has grown from, 4-ish trillion to over 8 trillion currently. And if the Fed were to monetize or take down all of this debt that isn't wanted anywhere else, you could probably just very quickly add another trillion to their balance sheet, which would start raising questions about the sustainability of the increasing debt, sovereign debt of America. So instead of having the Fed's balance sheet grow by another trillion, they create this, call it a permanent repo facility. And I love it when they say a permanent repo facility of $500 billion, because on a daily basis, they're actually doing repos to the tune of close to $1 trillion every day. So, it's sort of like, if you steal $1 million, and you say, well, I stole 500,000. No, you actually stole $1 million. If you stole $1 million, you stole $1 million. The amount of repos that are being done on a daily basis is far in excess of 500 billion. And, the amounts, Dunnigan, the amounts are obscene. And what it is reflective of is there is no natural buyer for the amount of debt America is auctioning or seemingly auctioning, because the real amount of money in existence is not reflective of the Fed's balance sheet or what we're told is total outstanding debt on the part of America. Because as you and I have spoke about several times in the past, at least several times, there are undocumented dollars that are existing. I would have it. My contention, I believe, is highly supported by the work of Dr. Mark Skidmore, who talks about 400 billion in assets under the Social Security Trust Fund umbrella, which get turned over. These are retirement funds, retirement assets, and they get turned over to the tune of 44 trillion in a year. So those numbers just don't compute. That's a neon sign, so far as I'm concerned, for fraud. And the true discussion of how big the fraud is maybe a great topic for another day, but let's just say it is highly indicative that there's something very untoward going on. So, you know, the repo facility is, and the amount of repos being done is highly reflective that there just aren't buyers for the debt, period.
So that's a big concern because it's the U.S. dollar's position as world reserve currency and so on that seems to be, the confidence behind that seems to be faltering if you're getting no one wanting to buy the bonds. There's two other aspects about this that I'd like to focus on. One is this idea of these emergency measures that are just keep coming since September 2019 of the original repo crisis, and then buying of junk bonds and one more thing after one more thing. This whole thing about emergency measures becoming permanent, it's starting to mirror and echo and rhyme with things that have happened in our lives over the past decade or two. We had the Patriot Act that was brought out after 9/11, and that was threat level orange and all this sort of thing, and then it just kind of, the TSA and all that got set up, and then it became kind of permanent. And then we've got new lockdowns and waves of restrictions related to the recent year and a half that seem to be getting entrenched in. Oh, don't worry, there's going to be another variant, and there's another variant. We had Fauci declaring that there will be more variants coming and that kind of thing. So, but specifically on the financial side, can you talk about the permanence of emergency measures on the financial side? Sorry, go ahead.
Well, I mean, sure. When emergency measures are permanent, they really aren't emergency measures. It's just the way of the day.
Well, although it may indicate that, in fact, in some cases, the underlying situation is so dire that you can't hold the thing together without tons of baling wire and duct tape and bungee cords.
Yeah, people of a certain age, Dunnigan, refer to that as MacGyvering things.
Yeah.
So
what does that tell us about the state of our banking system and the credit markets and the bond liquidity and everything?
Well, what's going on in our capital markets, Dunnigan, is very akin to a David Copperfield magic show, where David Copperfield entertains people by making Learjets disappear behind curtains. And in our financial system, we have many tens of trillions in derivatives, for instance, being swung around by the likes of 5 players in America, with many tens of trillions in notional in their derivatives books. And I refer to them as the Magnificent Five. And that would be J.P. Morgan, Bank of America, Citibank, Morgan Stanley, and Goldman Sachs. And, the size of the books that these people maintain and that they've established and that they maintain are absolutely stunningly large. And I mean, when you've got a derivatives book over 50 trillion in notional, like, if you want to think about that, and I find it absolutely hilarious and dumbfounding when people say, well, that's all hedged. And and they talk about it as a matter of it being, normal.
Yeah, legitimate, right? Mm-hmm.
There's nothing normal or legitimate about a $50 trillion derivatives book, because if you understand that these derivatives, the lion's share of them are interest rate derivatives. Interest rate derivatives fall under two sort of headline categories: interest rate swaps, which is let's call it a medium term interest rate product, which has embedded in it a cash government bond trade, at least for the bank. And when I say that, interest rate swaps, the lion's share of them that transact in the marketplace, the banks are on the buy side, and the exchange stabilization fund is on the sell side, or the synthetic lending side. The exchange stabilization fund takes naked interest rate risk, but the bank traders all have to trade as a spread over treasuries, or a spread relative to treasuries. And if the bankers were to take naked interest rate risk, like the exchange stabilization fund does, they would be fired. That's a firing offense for a banker to put on, for instance, for a banker to put on a naked $100 billion 10-year interest rate swap, not as a spread over treasuries. So without executing the cash bond trade, they'd be fired. Plain and simple. The exchange stabilization fund takes naked interest rate risk, and the very fact that they're doing these trades with the banks, it makes the banks captive buyers on a transactional basis of 3 to 10 year bonds. And isn't it amazing, Dunnigan? Every quarter where we see a ramp up in the outstanding aggregates in the interest rate derivatives, we see the bond market rally. So an increase in interest rate derivative aggregates is synonymous with rates going down, and sometimes very dramatically. Like in the first quarter of 2020, the outstanding aggregates in derivative land for these magnificent five institutions I just spoke of, the aggregates went up by 40 trillion in 3 months. And that was synonymous with the 10-year bond going from 1.8 down to 60 basis points. So it was cut by 2/3, from 1.8 down to 60 basis points. That was achieved by making banks captive buyers of U.S. government debt through the interest rate swap complex. So that's how they make the 3 to 10 year sovereign debt, or create synthetic demand for 3 to 10 year debt. The short end debt, which is T-bills, they use a different instrument to make the banks captive buyers on that front, because what they do there is they sell an instrument called an FRA, which in the interbank market, bank to bank, the FRAs typically settle against LIBOR, 3 months, 6 month, or 1 year LIBOR. But what happens when the ESF gets involved in the short dated interest rate derivatives, FRAs, they come in and they sell the FRA at rates lower than T-bills. So the banks have you see, what I'm trying to get across here, when the exchange stabilization fund makes banks captive buyers of U.S. government debt, they do so on a completely risk-free basis.
Right. I think you've talked to us about this sweetheart deal in the past, exactly what you're describing.
So they can't lose. I mean, if you want to think about it this way, 3-month T-bills will always yield lower than 3-month LIBOR. because 3-month LIBOR is the London interbank offered rate. It's where banks are willing to lend money. The government borrows cheaper than commercial entities. So, and T-bills always yield lower than LIBOR. So if I sell a 3-month FRA, which is a short-dated interest rate derivative, if I sell a 3-month interest rate derivative at a lower rate than T-bills, all the bank needs to do is buy the underlying T-bill for that period, and they can lock in a risk-free profit. So if I have a T-bill that yields, let's just say I have a T-bill that yields 50 basis points, and I can buy the let's call it the LIBOR equivalent in the FRA for 40 basis points. Mm-hmm. So I can lock in 10 basis points profit, minimum 10 basis points profit by executing that FRA, being the buyer of the FRA, and then buying the 3-month T-bill, and I'm locking in a guaranteed minimum of 10 basis points. And you might say, well, what's so big about a 10 basis point pickup? Well, when you're doing literally trillions of this at a go, or hundreds of billions at a go, 10 basis points on $500 billion is a considerable amount of money. And this is what's going on here. So the banks are risk-free captive buyers, and in being risk-free captive buyers of U.S. government debt, they are effectively executing U.S. monetary policy through our capital markets, through these captive arrangements they have. When the ESF, or the Exchange Stabilization Fund, has orders in the market, they do so only through the New York Federal Reserve Trading Desk, who is the broker for the Exchange Stabilization Fund. And Dunnigan, all I can say is it's a complete shame that nobody else in the world really talks about this, because this is one of the prime tools that are employed to MacGyver or keep, the chicken wire and the string and the elastic bands that are being used to hold some semblance of normality together in our capital markets.
Well, it also sounds like a huge conflict of interest. I mean, you could even say it's the chicken or the fox guarding the hen house, or if the Fed is actually composed of the banks and the banks are getting the sweetheart deal where they can't lose, it's like, wow, nice work if you can get it. We all wish we had that deal where we could get basically unlimited profits at no risk.
Dunnigan, I always use the analogy that what the banks are doing when they engage in these derivatives trades with the Exchange Stabilization Fund, when they do this, they are basically gaining foreknowledge of what monetary policy will be going forward. So when the Exchange Stabilization Fund is executing interest rate derivatives that make the banks risk-free buyers of U.S. government debt, those banks now know that rates are going down, and it's government policy. And this is akin to fishing in a barrel with a dip net, okay? And if you fish in a barrel with a dip net, as long as there are fish in the barrel, you will always get a fish, okay? And that's what the banks are doing. They're fishing in a barrel with a dip net, and there's always fish in the barrel.
It's ironic,
so
though,
because no risk.
Yeah, so this is the thing. You point out that they're not taking any risk because of this sweetheart deal, but it seems like everyone else is being forced into risk. Ordinary savers, retirees, pension fund managers, everybody else is being forced into risk.
They're losing. They're losing because interest rates are artificially being suppressed. Mm-hmm. A lot like the way precious metals are suppressed with naked shorting. So the banks, you see, we have regulations in commodities markets that, in theory, should prevent the banks from doing what they do. But we have regulators that don't do their job, and they look the other way. And the reason they look the other way is because the entity behind the suppression of precious metals is the government itself. So you have one arm of the government that's supposed to regulate and prevent this from occurring, but you have another arm of the government that's actually engaged in the suppression. So the government's never going to out itself. And that's why regulators don't regulate. And that's why this whole episode and exercise with Basel III, new rules by the Bank for International Settlements regarding unallocated and allocated gold, it's a bunch of hokum. It's because it's a new rule piled on top of existing rules that, if they were followed, would prevent this from occurring. But the problem isn't with our rules. We don't need new rules. The existing rules work fine. It's just that they're not being enforced. They're not being regulated.
The other aspect of what we just talked about, this Fed announcing this unlimited or permanent backstop facility, the Fed has been using this language now just constantly for the last year and a half, talking about unlimited funds, unlimited tools, unlimited facilities, and it's always we're going to help, we're going to support, we're going to stimulate. It's always to benefit. So,
it's to benefit themselves.
Well, that's the thing, is it's all being sold as like we're gonna be unlimited helping you, providing you unlimited help. Andy Schechtman, in my interview with him last, did a trivia question for our live chat in the audience, asking it was just announced, what is the U.S.'s greatest financial asset? So you look on the balance sheet of the United States, the biggest ranking financial asset is student debt. So here's this most powerful country in the free world reserve currency, and you look at the asset side of our balance sheet, the biggest financial asset the U.S. has is student debt. So we're sitting here saying, don't worry, the Fed says we're buying it all. Well, they don't say this. They just say we're gonna support you unlimitedly. But as Gregor Manarino points out, the Fed is buying it all, owning it all, and it seems like we're all doomed, ordinary people, all doomed to become debt slaves. But is that? Can you talk to about that principle?
But then again, look, I want to make this clear. They say they're buying it all, okay, and it looks like they're buying an awful lot of it. But my contention is they're not buying it all, okay? They're only buying a portion of it, because there's a whole lot more that's being soaked up, and it's being memory holed, and it's disappearing. It's disappearing into the ether, and you see. The dollars that I speak of, the dark dollars that are contained or held in the Exchange Stabilization Fund, that's money that isn't even acknowledged to exist. So if the Exchange Stabilization Fund buys debt, like when a country like Russia says we're not going to hold any more dollars, in days gone by, or in years or in decades gone by, if you had a major country sign off and say they're no longer going to hold any U.S. debt, the bond market, interest rates would back up. They would soar. In the bond market, we would say rates soared. They backed up a lot.
I get it.
But the reality is, in this past year, when Russia announced they were going to exit in their foreign reserve account, they were going to exit all dollar holdings. I mean, the 10-year bond went from 1.64 down to 1.44, like absolutely 100% counterintuitive to what should have happened. Normally that would create a sell-off, like a backup in rates. Instead, they rally, because the only way I can rationalize that or balance that is the Exchange Stabilization Fund is always ready with untold trillions in dark money, and they're always ready to step up to the plate and lend a hand and take down any amount of debt anyone wants to sell. And you see, the Fed can't buy it all, because if the Fed bought it all, the dollar would collapse. Because you see, when when the Fed speaks in terms of they're going to do whatever it takes, understand that doing whatever it takes means debasing the currency. Because implied and implicit in that statement is that they basically will print any amount of money, which they have, and they've actually printed a lot more than they admit. And the amount of money in existence is not reflective of the Fed's balance sheet, except the Fed's balance sheet is getting scary big. But that's only a part of the story. The rest of the story is hiding in the Exchange Stabilization Fund and the machinations that are occurring in the Social Security trust accounts, where $400 billion is being spun up to the tune of, in terms of churn, 44 trillion in a year? I mean, Dunnigan, that is not the way retirement assets are managed anywhere. Nowhere in the world are retirement assets managed where you have a turnover of 100 times in a year. It just doesn't happen. And anybody who would attempt to try and do that would be fired on the spot. They wouldn't get away with it. But when it's the government that's basically running a smoke and mirrors show, making Learjets disappear behind curtains. I mean, metaphorically, that's what they're doing. It's a hoax. This is a hoax. I mean, just like COVID is a hoax, our whole monetary system is a hoax. And we live from one hoax to the next hoax to the next hoax. And, the funny thing is, after a while, you kind of get used to it because everything's a hoax and you can't believe anything anyone tells you. I mean, they vaccines are safe and effective? Really? I mean, how are your blood clots? In the last 14 days, 3 people I know have had strokes. In the last 14 days. At no other time in my life, in a 14-day period, have I known 3 people to have strokes. Period. But, and they were all vaccinated. All of them had it. All of them had their shots. 3 of them, strokes in the last 14 days. And you know what? I'm sure over the next 6 months, I'm going to know a lot more people that have had strokes and or heart attacks or who have absolutely just passed away. But you see, we're told that they're safe and effective. And we're also told that the Fed will do whatever it takes to make everything good. And what they're doing to make everything good is to print more money. But printing more money devalues the existing monetary stock. You see, you can't spend your way to financial health.
That's one of the things I wanted to ask you about. Again, back on the idea of sovereignty of our people, we the people. If student debt, for example, just as a poster child here, if that's the largest financial asset of the United States, then it's like, okay, we the people have become so indebted that our own debt is the largest asset of our country. How does that reflect the true financial health of any nation if the debt of its own people is its greatest financial asset?
Well, it's done again. There's a name for it. It's called a house of cards. Okay, and when you build a house out of cards and a little breeze comes along, the house falls. And in monetary terms, an ever-ending expansion of debt and credit leads to default. Okay, and that's when the house of cards collapses. And because if you borrow enough money, you will bankrupt yourself. And I mean, it doesn't really seem to apply to a lot of sovereign entities, particularly in Europe, where they have negative rates attached to much of the sovereign debt issuance. But in America, let's just say we don't have nominally negative rates yet. So positive rates of interest still apply in the Western world, where governments have to pay something. And the funny thing is with debt, at some point, if you borrow enough, it doesn't really matter what the interest rate is, so long as it's positive. It'll bankrupt you.
Isn't the management tactic that's being employed right now is that if you can debase faster than that nominal rate, you can continue to pay it off because you can just create more currency?
Well, in theory, I mean, I understand where you're trying to go with that, but you see, the problem is, the amount of debt there is in the world isn't just sovereign issuers. Okay, I mean, most people through this COVID experience have drawn down on personal credit lines, and or spent and borrowed against their credit cards, and you name it. And you see, you and I don't get to borrow at zero.
Mm-hmm.
Okay,
Mm-hmm.
run a balance on your credit card and see what kind of interest you're paying.
Yeah, and all those landlords that are not getting paid rent, whether it's at the residential level or the commercial level or whatever, verbos or whatever, they're having to do extreme measures in their own lives. And you're right, they don't have those unlimited zero facilities to draw on.
Exactly. So, so what it really comes down to is interest rates aren't zero. I mean, not for us. For the people, for the bankers, yeah, interest rate zero.
Well,
for
it's
the
kind of
government,
like, if I were Rob Kirby, I'd be saying it's like we're all underwater, we're all holding our breath, and only some of us have oxygen. The rest of us are just holding our breath. So it seems like there's going to be a culling.
That's right.
There's going to be two-tier society here. The ordinary people that are being forced to take all the risk and don't have the oxygen, and the other ones who have not take any risk and they get the oxygen.
Well, I mean, and in financial terms, that means most of us are staring at bankruptcy, while the privileged class, the bankers and the governments, they get to continue spending like drunk sailors, and they get to keep reworking the world in their vision, or with some vision, and continue to reshape the world as they see fit. But it doesn't work that way for the rank and file people like us.
Okay, so what are rank and file people like us to do to... We've talked about this a little bit before we started interviewing, and that is you keep saying we're in interesting times. Bewildering times where it feels like no matter which way you turn, no matter where you move on your checkers on the checkerboard, you're going to get whacked. What options are open to people that are lower risk than others?
I sound like a broken record saying this, but you need to rely on the anti-dollar trades, and the anti-dollar trades are physical precious metals and cryptos, so far as I'm concerned anyway. And there might be an argument made, for buying some productive farmland. I personally wouldn't be a huge buyer of residential or commercial real estate, but you want to own anti-dollar, or things that are viewed as being anti-dollar, things that reprice themselves when currency is blatantly debased. So the more printing that occurs, in theory, the worse the dollar should do. But we live in a world where Learjets disappear behind curtains, or the equivalent of Learjets disappearing behind curtains happens because we have rank manipulation, where unnatural outcomes are being perpetrated through brute force, overwhelming any opposition or any contra position. So, I mean, understand, if you can, the many unthinkable trillions of dollars that can be brought to bear on any market that the people at the Treasury wish to do. And I keep talking about the Treasury. A lot of people speak in terms of and think about interventions. Just remember, what really key to remember, something I said earlier. When the Exchange Stabilization Fund acts in any of our capital markets, They do so through the New York Federal Reserve Trading Desk. So to market participants, it looks like the Fed is in the market, but it's not the Fed at all. It's really the Treasury. It's the Exchange Stabilization Fund. Because a lot of the trades that the Fed appears to be doing, I can assure you the Fed would never do these trades. The Fed is not going to take naked risk with US government debt. Okay? They won't do it because they're not going to risk their own capital to a bunch of drunk sailors. So they act as agent for the Treasury, and it's the Treasury or the ESF that takes the risk. But understand, the ESF doesn't report annual financials. They're not answerable to anybody. They have no oversight from Congress. And they're operated as basically a private fiefdom. And I would argue steadfastly that they're actually controlled by the intelligence community. And we can thank none other than George W. Bush for effectively handing over the control of the covert side of the financial realm, which used to be the exclusive jurisdiction of the executive branch of the government. But back in 2006, George W. Bush pretty much handed that baton off to the intelligence community so that they could run amok. And interestingly, it was around about that time period when the intelligence community basically took on a somewhat of a new persona, and they became much more arrogant, and they became much more aggressive in their attitude and their overall way of acting.
Audacity of action, but also it's in your face and not denying it anymore when challenged. It's like, we'll do what we're going to do. And FASB 56 came along in the same time frame saying, hey, by the way, anybody who asks what we're doing about auditing our books, we're not going to talk about it because it's national security.
Well, basically, FASB 56 is actually more recent than 2006. FASB 56 was a 2019 phenomena, and that's where the American government, federal government, said, we basically are not going to be held to any accounting norms anymore. We can now keep two sets of books, and if you want to see our books, no, you cannot see our books. And anything we show you may or may not be true. And that is the essence of FASB 56. Accounting is gone.
I wonder if we the people tried doing that out of mirroring that and saying, well, in the interest of national security, based on we the people, we're going to have our books be private and sovereign as well for every household, every individual. Wonder how many people it would take to form a critical mass there. That's one question I had for you about critical masses. As people, you mentioned the unlimited funds available can move any market that they choose. Partly that's able to be done as long as these are paper markets. Rick Rule talks about less than 0.5% of people's investable net worth is in like precious metals, natural resources, that sort of thing. As in the past, that's gone up as high as 8%, certainly as high as 4 and 2.5%. We've seen at different times. If there's an awakening among more and more and more people, as there seems to be starting to this spring with the silver squeeze and all that, to where more people who've never been involved in precious metals investing before, if more and more households stop being debt driven and start being hard asset foundational holdings, will that at some point form a critical mass that will make this willy-nilly manipulation by these extra trillions in markets nullified?
The reality on that front, done again, unfortunately, is that many of the big the people who have muscle to move markets, whether it's a person like a Ray Dalio who runs a huge hedge fund, or Paul Tudor Jones, who runs a very, very well-known large hedge fund. Let's just say in the past, when these people have said that they're bullish on metal or buying gold, what they're buying is either GLD or an exchange. Basically, it's a paper product. Okay, and there's a reason why they choose to get their gold exposure that way. I mean, they don't want the cumbersome nature of owning physical metal, which they feel that there's threat if they ever wanted to liquidate on short notice. They could be subject to having metal reassayed or having it rechecked, and that makes them fearful that they can't get out of a trade and free up their capital on short notice should they desire to or need to. So as long as the really, really big institutional investors continue believing that they have true gold exposure when they buy futures or when they buy GLD, the necessary run on physical that one would expect to occur doesn't materialize. Because, I mean, if you're an institutional buyer, you can buy all the GLD on the planet you want, okay? And they'll just keep selling it to you. And I mean, in theory, that technically shouldn't be possible.
Yeah.
Okay. If GLD was run as a truly straight enterprise, and if they really had an ounce of gold for every ounce they sell in paper form, but I can assure you that isn't the case. And I mean, what makes me say that that's the case? Well, I mean, if you read the prospectus is very ambiguous. The prospectus speaks of the framework and how this exchange traded product works, with a series of sub-custodians, and they basically give themselves plausible deniability that they don't have to have the metal that they claim they have. And so, I mean, reading their prospectus, it's riddled with inconsistencies, and it's basically riddled with backdoors. So it doesn't need to be that way. I mean, there are products in the gold market where they have prospectuses that are very clean, and you know they have the metal because it's highly documented and it's very transparent.
Right.
But why does somebody who owns the biggest or creates the biggest supposed gold fund in the world, why do they have a prospectus that's ambiguous at best, and it's basically riddled with backdoors, and it's not transparent? When there are examples of the opposite, but they don't have the same heft or traction as GLD or SLV.
Yeah,
but I mean,
been a big. We've interviewed like Wall Street Silver several times. They've got this lovely chart that shows GLD participation going down, and like PSL or PHYS, the physical alternatives of those that are available from other custodians going the opposite direction in the last couple quarters. Well,
yes.
Rob, I noticed that we're running out of time. I'm very grateful for your coming. We're going to have to make it less lengthy. I know we both had some constraints this time. We're going to have to get you back on sooner. But as always, on behalf of our viewers, just very grateful for your presence here on Liberty and Finance. Folks, also, so you don't miss a single interview with Rob, make sure you go to libertyandfinance.com, put your name and email address in the left-hand side, click submit, get on our email list so that you'll get every one of our episodes with all of our guests, including Rob, and any links to articles that we discuss will be in there as well. Rob, any place that people should look for you online to find out more of your work?
My spot on the web, kirbyanalytics.com, and interviews with such fine establishments as Liberty and Finance, and the great Dunnigan Kaiser. Been a pleasure knowing you. Been a pleasure doing interviews with you.
Well, we're always grateful for your presence here. We're always, you and I, observing the state of affairs, always wonder if we're going to get to do another one. So hope we get you, have you back, and have you back soon. Thanks for joining us.
Been my pleasure.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs. Welcome back.